Are you still an unprofitable trader? If so, this video should help change that. So we're going to go through a strategy. I'm going to show you how to do it. And the reason I really love this strategy is there is no subjectiveness. You're not drawing your own levels. The levels are drawn for you. So it's not saying, oh, would this be a level? Would this not? The levels are clear. They're clear cut and easy to trade. So to get straight into it, these are the levels. Standard Deviation Channels. So if you're on Thinkorswim, this will be built in, and all you would do is add these Standard Dev Channels, and you would add a deviation for 1, 2, 3, and 4. So again, all you would need is search Standard Dev Channel, add that 4 times, and again add 1 for the first deviation, 1 for the second, 1 for the third, and 1 for the fourth. And again, you can change your upper and lower lines if you want to match mine. So if we're drawing this fourth deviation, this will be the red one. So again, all we would do is change that to red on both the lower and upper line. So that's how you add the indicator. Again, that is all we are going to use to trade. So should be super clear, should be super simple. Now, the first thing you want to do with these levels is firstly see what the stock is doing. So right now we're looking at Roku just because it's a big movie today. We are up 25%. Again, this is being recorded on Friday, the 28th of July. So we can see it's moving. And again, you can check these levels in future. How did this play out? So firstly, what we like to check is what's happening over the longer term. So this left chart is a 6-month. This right one is a 1-year chart. So again, make sure you're on these time frames, 180-day, 4-hour chart, and the right one, a 1-year, 1-day chart. So that's what we want to be on, 1 chart of each. And again, we need 2 charts for this. So what you can do, and the deviations make it really good to see it, is a stock in a... Is it range bound? Is it uptrending? Is it downtrending? So Roku, for example, 6-month, very clear uptrend. On the other hand, when we're looking at the 1 year, we're a bit more range bound. So again, you don't even have to look at the candle itself. Just look, where are the deviations? So deviations are basically facing flat. It's range bound. And again, I mean, it's quite clear. You hit that low, that high, and now we're coming back to the top of that range from a 1-year outlook. And from the 6-month, again, obviously these deviations are very clearly trending up. So that tells us we're in a more bullish trend on Roku. And obviously today we have had earnings and we are spiking up 24% off this news. So now how do we actually trade this strategy? And all it is looking at these deviations. So again, firstly, do you understand what standard deviations is? For a quick rundown, this is our first deviation, this is our second deviation, this is our third deviation. Again, that's the same to the downside, first, second, third. You've probably learned standard deviations before, whether that's in school or just in some other part of your life. So first deviations, 68% chance you trade, or 68% of the time you trade within your first deviations. You then go to the second deviations. This is where 95% of data should trade within. And then going on to our final and third deviation, that's where 99.7% of data should trade within. Now, this is a stock market. Nothing's actually going to be that accurate, but what it does do is give you a good signal that if you're at your second, third deviations, there is a good chance we are going to start to reverse. And that's what this strategy is. It's a reversal strategy. So if you're looking for a trend trading strategy, this is probably not it. There's probably a way to use these to trend trade, but again, I've only ever tested and I only ever trade the reversal standpoint of these stocks. So now we know what these levels are, how to add them to your chart. Now, how do we actually use these levels? And it's very clear. All you need to do is wait for the first time they come into that level. So today, for example, on Roku, we're moving up. We've hit $80.20. This is our our second deviation from the 1-year chart. And then what you can see, we've also hit $85.35, which is our second deviation from the 6-month time frame. So we've hit both of these levels today, and this is usually quite a bearish signal. So now we can look to play the reversal over on Roku. And what's happened on Roku previously when we hit these second deviations? That's what I have dotted out here. And again, to prove this, what we can do with these standard deviations, they're not like moving averages. They move in time. If you come and check the levels tomorrow, they will slightly adjust. So you have to go back in time if you are backtesting. So that's what we will do. And so what you can see, this is the first time this year we hit our second deviation. And what date was that? That was the February 15th. So what we can do is go on demand, and this is a great thing of using Thinkorswim. We can go back in time, test things. So again, we go back to February, we go back to February 15th, we see where are these levels and how did we react after we hit these levels. This is actually the exact same thing as we basically have today. Earnings have released, and off these earnings, we have pushed up. And again, we've now hit this level, and what level is that? If we zoom out to our standard deviation charts, you can see that's our second deviation. So that's what we've come to hit. Now we've hit this level. This is normally a swing trading strategy. Again, you can day trade this, but I think swing, you have a lot higher probability. It's a lot easier to trade. So I tend to swing trade when using this strategy. But what we can see is we've hit this level. Now, I turn short price on the stock. I want to play against it. So there's multiple different ways. I don't tend to trade naked shares myself. So instead, I look at trading options and shares. So that might mean covered stock. What that means is you short the shares and you buy the calls. And what that will do is define your risk. So you don't have unlimited upside if Roku continues to tear. You know exactly how much you're going to lose. But again, we have videos on our channel about covered stock. You can also trade them through vertical spreads or just outright puts if, again, you're looking just to trade options only. Price come into this level. Now all that means is, again, I want to be I want to play this to the downside. So again, we can buy a put, for example. So what we can do is go over to the trade ideas, or sorry, the option chain. Again, normally you could look to go out a month, maybe two. That's going to be more down to personal preference. But for this case, let's say we go out a month, so 29 days to expiration. Again, we're currently trading at $73, was it? A bit pulled back down to 70. So let's say we get a $70 put. This is going to cost us $475. So then what we will do is we will fast forward. We will go forward, say 2 weeks. So this option's then got about 15 days less to expiration. How much is it now worth? So there we go. We're now on March 2nd, so 2 weeks ahead. Everything's now loaded. Again, we're looking at the same expirations, 15 days to expiration, 17th of March. Now, what are these $70 puts worth? They are now worth $700. So they're up just under 100% really. So this is the strategy basically. It's just playing the opposite direction, playing the reversal trade. Now, again, if we go back to the chart, how does this look? That was our entry, and all we've done is sell off till now. So again, we can look to get some, there's better ways to get out and into these trades. Obviously we would have got a better entry on the day. We would have shorted at the $73, which would have made our entry a lot better. And again, what would we use as targets? We use deviation targets or levels as our target. So you can see around $59. That was our closest deviation. So again, we could have locked in some profits as we come into there. But again, these are things you adjust and use as you continue to trade this potential strategy if you want to trade it. But we're just going through how we would use it. And again, then you can adjust it to how you like. But if we're shorting roughly at that level, you can see obviously we have had a strong pullback. And again, you can go back and test as many of these as you like. I'm just showing you one example, the Roku examples. That's one time we've hit it. We then hit it again. We hit it again. Each and every time we've had that pullback. Again, this is quite clean. We're never going to be that accurate. You're going to have losers like any strategy. But it was a good signal and quite good to see that, we keep seeing this overall reversal. And again, don't forget, this is in 2023. Markets have been bullish. So we are playing against the trend of the overall market and we're still getting winners like this. So that's why I like that strategy. But yeah, that is basically how the strategy works. I don't want to long this out and bore you. I want to try and make this quite clean and quick and simple. And again, if you have questions, obviously ask them in the comments. It's as easy as that. Put the standard deviation channels on the first time we come into this. And when I say the first time, I'll explain what that means. Because obviously we've hit it there, we've hit it there, we've hit it there. So what you want to watch for is when we come back down to fair value. So this middle value here is basically considered fair value. Once you come back and retest that level, we can then look to retrade the level. So now we're hitting these for the first time since we hit fair value. As we come into these levels for the first time, we can look to play that reversal. And again, even if these turn out to be losers, that's fine, because that was a winner, that was a winner, that was a winner. And a lot of the times on this, again, depending how you want to execute this, covered stock, outright options, vertical spreads, you can get different risk to rewards. You know, a lot of the times you can do a 1-to-1, but a lot of times you can do, you know, a 1-to-4, especially when you're shorting the second or third deviations, because if it continues to go against you, you hit your max loss on whatever you paid for the options, or your risk, your options are defined, or your risk, or whatever. Your max risk, if it continues to against you, you know how much you're going to lose. But let's say you're risking $500. So even if it goes up to $100 or $120, you lose $500. But if it comes down to, say, $90, test this level, you're up a 1-to-1 risk to reward. So you make $500. If it then comes down to your next take profit, you could then be up $1,000. So, you know, depending how you enter this strategy, and again, you can throw it into the analyze tab and look how these options will play out, or the stock, the shares, or whatever will play out. But, you know, even say on a worst case, you're getting a 1-to-1. From personal experience, I see this work more than it doesn't, meaning it works more than 50% of the time. So even if we're only getting a 1-to-1 risk to reward, this strategy should still be profitable. I don't want to overcomplicate things. Basically, the first time we come into the level, we look to play that reversal. That is the strategy. Again, if you have any more comments, let me know. And if you want a more in-depth video, we can definitely do that. But I wanted to keep it clean and simple for the time being. I hope you guys enjoyed the video. If you did, why don't you check out this video, because you'll probably enjoy that one too.